Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to another episode of On My Way to Wealth. Thank you all for tuning in and for being patient with me. You know, this is tax season. If you're listening to this in real time, it's April 2023, and I'm just wrapping up tax season, but I couldn't have you guys wait any longer for another episode. So it's been pretty busy, but it's all good. We're here now. So I wanted to talk to you today about the pros and cons of borrowing money from a 401k. I have a lot of clients that ask me sometimes when they encounter certain situations, whether or not it makes sense to take money out of their 401k. And sometimes it does, sometimes it doesn't. So I wanted to go over some of those situations and when it makes sense and when it doesn't. And so just some things to look out for. And as well as I'll give you some alternatives at the end so that you have an idea of where else to look in addition to possibly borrowing from your 401k if it comes to it. So the first thing I wanted to talk to you about is a clear distinction between borrowing from a 401k and withdrawing money from a 401k. They're not one and the same. So, and it's very important because they can have significantly different implications, especially on the tax side. So when you withdraw money from a 401k, you contact your 401k administrator or your employer, you let them know you want to actually take money out of your 401k. Some employers would provide you for the ability to take money out as a hardship withdrawal. And sometimes you have to show documentation or some sort of hardship that you're going through. And that could be some medical bills, or you're behind on your rent or your mortgage, something like that. Another one could be there's an exception for taking money out if you're buying a house, for example. And I'll talk a little bit more about that later. But ultimately, a withdrawal then literally takes money out of your account and you don't have to pay it back. They just give you the money from the 401k. What that does is that it creates a taxable event for you because now that money gets issued to you as a 1099-R at the end of the year and it becomes taxable income. So in addition to whatever earnings you had during the year, if you take a withdrawal from your 401k, that money gets added to your income. And that can have a lot of consequences because in addition to income taxes, there can also be a 10% penalty. There are some exceptions to the rule, but for the most part, you will pay a 10% penalty if you're under the age of 59 and a half. So now you're talking federal taxes, state taxes. If you live in a place like New York City that has a city income tax, city tax, plus a 10% penalty. I remember when I was working in New York with some of my clients, I would tell them, yeah, that's going to cost you about half because it was like their tax bracket at the federal level, state level, city level, plus a 10% penalty. It's a hefty fee to pay. So it's one of the places I always tell people to leave as the absolute last resort. So I wanted to make very clear that distinction because withdrawing from a 401k and borrowing from a 401k are two completely different things. Now, let's talk about borrowing. In this instance, I'm talking about when you have an existing 401k via your current employer, not an old 401k that you've had from a prior employer, because those you cannot borrow from anymore. You would have to make a withdrawal like the ones I was talking about, or roll it over into an IRA and take money out of that IRA. But there's really no loan. You know, some withdrawals from an IRA, for example, would allow you to take money once every 12 months, but you have to put it back within 60 days in order to avoid the taxes and the penalties. So really not that many options. So I want to talk about borrowing from a 401k from your existing plan at your current employer. One thing to note is that Secure 2.0, the act starting in 2024, is going to allow for people to make up to $1,000 in some sort of emergency withdrawal from the 401k without charging the additional 10% penalty, which is great. But that's until next year. So when that rolls out, maybe I'll do another episode to talk about some of the details, how 401ks are impacted via the Secure Act 2.0. So let's get right into it. As of now, you can borrow up to 50% of the vested balance in your 401k, up to $50,000. So basically, if you have $120,000 in your 401k, the maximum you can borrow is still 50, right? Because even half in this case will be more than the $50,000. So the maximum you can borrow from the 401k is $50,000. Now, during COVID, there was a special opportunity for people to take a coronavirus-related distribution if they were affected by coronavirus in the pandemic, where you were able to take up to $100,000 from a retirement plan like an IRA or a 401k without the 10% penalty, and also being able to spread the income taxes over a 3-year period as opposed to paying taxes and all of that at once. And then also the ability to repay it within that 3 years. And if you did, you would then amend your tax returns and get your money back for whatever taxes you paid, right? But that was just a special circumstance. So now we're going to focus on just borrowing from your 401k. So you can borrow up to $50,000 depending on the balance that you have. So no more than 50. So usually half of what you have in there. So if you have 40,000 in there, you should be able to borrow $20,000. Some of the pros. Number one is that you do not need a credit check, right? Because you're borrowing from yourself. So if you find yourself in a situation where you just need this money, you explore your other options, maybe it's more expensive or harder to obtain, you should easily be able to just contact your 401k provider, borrow from your 401k. They don't run a credit check. You're pretty much approved for it, right? So that's one of the advantages, as opposed to having to apply for a loan somewhere, right? Where they're going to run your credit check. Maybe they want to see some income documentation and so on, and the process might take longer. So sometimes, depending on the situation, this might be a way to go, right? Another advantage of it is that you may get a lower credit interest rate on this loan than you would on any conventional loan. If you compare it to just like borrowing a regular personal loan or something like that, it might come with a higher rate. So the 401k loan might look more attractive as a result, because in addition to not having a credit check, you will be able to borrow at a lower rate, most likely than conventional. Another great thing about that is, since we're talking about interest rate, is that you're paying yourself back. Right? You're borrowing from one pocket, you put it in the other, and as you make payments back, you are making payments back to yourself. However, there is a caveat, which I'm going to talk about it in the cons section. So remember, you're paying yourself back with an asterisk, right? Because there's a small thing that some people tend to overlook that is not necessarily as attractive. Another great thing is that this is not used against your debt to income ratio. If you've ever borrowed a mortgage or looked into buying a property, you might have heard the term debt to income ratio. And what that means is when you look into borrowing a mortgage, the lender or broker is going to look at your total monthly debts. And so all the minimum payments on all your debt, plus the proposed monthly payment on the property that you're buying or refinancing, and divide that by your gross income. And normally they don't want, that's called the debt to income ratio. They don't want your debt to income ratio to exceed a certain number. So let's use, 40%, for example. That means that you cannot have all of your debt exceed more than 40% of your monthly gross income. And that's the way the banks look at it. Otherwise, you don't get approved because then they feel like you're overextended. So one of the advantages of borrowing from a 401k is that the payment, since you're paying yourself back, and that's what the bank considers it, is not considered a monthly payment as you would consider a loan that you borrowed elsewhere. So in a sense, it doesn't further increase your debt to income ratio, which would be a bad thing. So some people borrow from the 401k when they're buying a house. Let's say you were short either on your down payment, your closing costs, or you just wanted to have additional money to complete the transaction. You can borrow from your 401k, use some of that money towards the mortgage, down payment, whatever the case might be, and the bank is not going to count that against you as a loan that you have to pay back as they normally would consider a regular loan. So it doesn't impact your debt to income ratio. And obviously double check with your lender before you do anything like that. But that is one of the upsides. I've spoken to some lenders that I know directly, and that's what they've shared with me, and I've also looked it up as well. And it's typically not considered against you when it comes to debt to income ratio. So that's an advantage, right? Because then you're able to use some of the funds you already have and not have it impact your ability to qualify for your mortgage. If you hear real estate agents and mortgage lenders out there, typically they tell you, hey, here's some of the things that you shouldn't do when you're buying a house. And one of the things I see all the time is obtain new credit, right? Some people get excited, they're buying a new house and they go to, one of those major places where they sell couches and living room furniture and so on, and they borrow money to get a new living room set and so on. And now that comes up on their credit report. So now they have a new ding on their credit report. But more importantly, the payment on that shows up as another payment, which now affects their debt to income ratio. And the underwriter at the bank now has to recalculate your debt to income ratio and make sure that you still qualify for your mortgage, right? So they tell you, don't go out buy a new car, don't go lease a new car and so on. So this is one of the major benefits of borrowing from your 401k in this instance, right? Another thing is that there are no tax consequences, and I'm going to put an asterisk on that one as well. So when I talk about it in the con section. So what it means is, as you recall, as I was talking about the difference between borrowing versus withdrawing, when you take a withdrawal, that becomes a taxable income. When you borrow, it does not. So it doesn't create any type of negative tax consequences from you. You can borrow, let's say, up to the $50,000 amount, then you start repaying that back via your payroll, and then it's all good, right? You're paying interest, it's fine. You don't have that negative tax impact. You don't get a 1099-R at the end of the year. You don't owe money as if it was income. So that is a positive thing, one of the pros of borrowing from the 401k. Now, let me give you the bad news, right? And it's all about you making an informed decision, which is why it's so important that you speak to a financial planner and also evaluate all of your options to make sure that you're doing what's the best thing for you financially. Because 401k, it's probably one of the last places you want to look at, even though it has some of these benefits that I mentioned. And I'm going to go into some of those reasons why now. So let's talk about the cons. So remember I said there were no tax consequences in the pros? Well, it's not entirely true, because if everything goes according to plan, then yes, you have no tax consequences of considering that income. However, what happens if you leave your job, whether it's via layoff or you switch jobs and you have a 401k loan? Well, now it creates a problem for you, because normally it used to be you had 60 days to pay off the balance of that loan. And if you didn't, it will become taxable income, similar to the withdrawal. It just, if you don't pay within this 60 days, now the law has changed and you now have until the tax filing deadline of the following year. So it's a little better, but ultimately still, if you took out a loan that you were expecting to pay back over a 5-year period or 3 years, and let's say it's October and you get laid off, well, you now have until April of the following year to make sure that you pay that loan back, because if you don't, then it actually becomes taxable income to you. The company is just going to write it off and you're going to get a 1099-R. And if you were on the DH of 59.5, then you're going to get paid with taxes and a 10% penalty. So this is one of the things you have to consider, because, make sure that you feel comfortable in your job, or that if you're thinking of leaving or a potential layoff, that you have an idea of how that's going to impact you and how you're going to deal with this, right? At that point, you go borrow from somewhere else to pay off your loan so that you don't get hit with the tax penalties, right? So this is a huge one, especially if you get laid off. Because think about it this way. Imagine you borrow from your 401k, whether it was to pay off some debt or buy a property, whatever the case might be, and then you get laid off. Well, now you lost your income. And on top of that, you got to pay this loan back in full before the next tax season is here, because otherwise you're going to pay income taxes. So it's really could potentially be a pretty hefty consequence, which is one of the reasons why you want to understand that this potentially could happen to you, right? So you don't want to just look at the positives and say, okay, I'm paying myself back, it's all good. You could potentially be negatively impacted with a high tax bill and a 10% penalty. So think about that. The second thing is, people say, well, I'm paying myself back. And that is true. You are paying yourself back. So that is good. Most interest rates are usually based on the prime rate, and the prime rate gets added to in order to determine the rate. So it could be like prime +1, prime +2, something like that. It's where you end up paying yourself back, which is good, especially when the prime is high, you're paying yourself back. But what people don't realize is that there's a double taxation aspect on the interest that you're paying yourself back. Most people don't realize this. Think about it this way. Your 401k is funded with pre-tax dollars. When you take a 401k loan, you have to pay that loan back with after-tax dollars. You don't get to put the loan payment through your payroll back as a pre-tax amount. You get paid, you pay taxes on it, federal, state, Social Security, Medicare, all that. And then with your after-tax dollars, you put the money back into your 401k, right? So now you've paid taxes on the interest that you're paying yourself. And guess what? When you retire and you start taking that money out, you got to pay income taxes again on that money. So you're paying taxes twice, not on the whole thing, but on the interest that you're paying yourself back. And maybe that's not a lot necessarily. It might be a minimal amount depending on how much you borrow and how long for, but it's something that you can't just put under the rug. Like you have to know that, like you are in fact paying yourself back, but you are paying with after-tax dollars and therefore subjecting yourself to double taxation on the interest that you're paying to yourself, which is, could be significant. So something else to consider in addition to the potential tax consequences of just having to claim that income as income, right? Here's another thing that it's not necessarily, it's something that you do to yourself. You may not necessarily plan for it this way, but when you take the 401k loan, those funds get removed from your 401k. So they're no longer invested, right? So you're missing out on the opportunity for those funds while you're still repaying them to participate in the market, right? So over time, if the market does well, let's say you borrow 3-5 years on your 401k, that money, as you continue to pay it back, the chunk that you have not paid back is actually not being invested in whatever funds you had in your 401k. So you could potentially miss out, right, on the rate of return that you would have earned had those funds been in there. Yes, you're paying yourself interest back, but maybe that interest you're paying yourself, which is one of the pros, was that the interest rate was lower, right? It won't be as high necessarily as the rate of return you possibly are foregoing on the investments in the 401k itself, right? So something else to consider, right? Because now you're missing out on money that could have just stayed invested. And then to add, I call it a double whammy, right? To add insult to injury is the fact that a lot of people, when they borrow from the 401k, sometimes either the ability to contribute to your 401k gets suspended, depending on the situation, or you might just voluntarily stop contributing to your 401k because now you're focusing on paying the money back, right? So then you're taking money out of the market. You're also not contributing further to your 401k because you're focused now on paying the 401k loan back, right? And so you just added yet another layer of not treating your future self with the best care because you took money out of the market and you're not contributing back to it until that loan is paid off, right? And we're humans, so that could happen. It's like, well, now I have to pay this loan back. Why would I contribute to my 401k? I just want to pay this loan off and then I'll get back to contributing. So now you're postponing and skipping a fairly high amount of time that you could have just stayed with your money in your 401k plus continuing to invest in it. And if you're not contributing, what else may you forego? Any potential employer matching contributions as well, right? Which maybe it's a third insult to injury, because if you were contributing before you took that 401k loan out, you had money in the market, you were putting money yourself, and you were getting a contribution from your employer as a matching contribution. If you borrow from your 401k and you suspend your further contributions, not only did you take money out of the market, that chunk that you borrowed, you stop contributing further to it, and then you make your employer also stop contributing, because if you don't contribute, then likely you're not going to get that match, depending on how your plan is set up, right? So that's pretty bad, right? So it's something really to consider, especially if you're thinking of doing a long-term 401k loan. Something to really think about, So now that I've given you a lot to think about, right? What are some of the pros, some of the cons? So we talked about, the ability to borrow up to $50,000, up to half of whatever you have with no credit check, a low rate, not used against your debt to income ratio, no immediate tax consequences, maybe some potential ones, right? Paying yourself back. That all sounds great. Just recapping the major points before I give you some alternatives. Potential tax consequences on the con side, right? Both from having to pay the loan back in full if you leave your job, or you get laid off. If you don't, paying income taxes, 10% penalty. Also, double taxation on the interest because you pay with after-tax dollars. Also, not having money invested while you repay it, plus you yourself not continuing to contribute and maybe foregoing your employer match, right? So those were some of the cons. Now, what are some of the alternatives? One, I did an episode at the beginning of the year, we'll talk about some of the opportunities to take advantage of in New Year's. I've seen some very aggressive 0% APR balance transfers that come through in the mail and online. A lot of banks out there are being very aggressive. I had a client the other day, I think they were all for like 22 months with 0% on a credit card. A lot of the times these credit cards, they'll send you a check where you can take advantage of a balance transfer, deposit the money in your account, and then use it for whatever it is that you want. It doesn't necessarily have to be transferring a balance from another card. You can literally get a check. Obviously, there's some fees involved, so you want to take a look at that, see if it makes sense. But that could be a better alternative, especially if it's a short-term measure. If you get a credit card that says, hey, we'll give you 0% for the next 18 months, and you needed this money for something that you were planning on paying back within a short period, it might make more sense to do that than borrowing from your 401k for a lot of the reasons that we talked about. What's another place you can look at? If you own a home and you're looking to do home improvements, maybe a home equity line of credit might be a better option, because you can deduct some of the interest as indebtedness, basically that qualifies for the IRS guidelines because you're using the money. There are some limits, but and you got to talk to your accountant about that. But using money for home equity, very likely if you stay under those limits, you can then use that interest and deduct it if you used it to improve, either to purchase or build or improve your property, right? So a home equity line of credit might give you that flexibility. It might give you more flexibility in terms of how to repay it, right? Some home equities have an initial period where you can pay interest only for a bit. So depending on your cash flow and things like that, that could be another alternative. And then another place to look at is just personal loans. Maybe the interest rate is not as juicy as a 401k, but it's a fixed payment. Once you lock in your rate, okay, I'm paying X amount for the next 3 years. When you're done, you're done. And you don't have to worry about tax consequences, double taxation on interest, removing money from your 401k, none of that stuff. So this is why I think it's so important for you to have somebody in your corner that you can talk to, like a financial planner, that can help you determine all these different things, because it's not all about just investing. It's about doing the things that are the best for you and your situation, right? So if you need to access some money, yes, the 401k is an option, but don't immediately just go there. Consider your other options. Talk to somebody that has your best interest at heart, that knows finances and can help you go in the right direction. This is why I'm a big proponent of having an emergency savings. And you probably heard me say this a million times. If you have a great emergency savings, as much as you possibly can, traditionally, again, you hear people say 3 to 6 months worth of expenses or 3 to 6 months worth of salary, depending on who you talk to. If you could have a year, even better, right? Not all of us could do that, but this also highlights the reasons why we want to have those emergency funds, because maybe that would be the best place to go before you tap into a 401k or have to borrow from a home equity line of credit or 0% APR credit card. If you work towards building that emergency savings, you'll be in a better position because you could withstand something unforeseen like a temporary layoff in some sort of emergency without having to resort to borrowing, and taking money from your future self, like taking money from the 401k. So try to make it as concise as possible. I hope you find this useful. As always, if you have any questions, feel free to send me an email, luis@onmywaytowealth.com. Thank you for tuning in. For those of you listening, you can also see me on the video on the YouTube channel. And if you see me on YouTube, you can listen to the podcast wherever you get your podcast from. Thank you all for tuning in, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.